Recording in progress.
Hello, good evening, everybody. Can y'all hear and see me? If y'all can hear and see me, don't mind type a one so that at least I know everyone can hear and see me. Okay, thank you for responding. Okay, uh, today we got very much lesser crowd, maybe because of the topics or a lot of people just wait for the recording. Okay, anyway, we don't wait for the rest. We will just proceed on that. Okay, today we'll talk about ETFs. Okay. Hmm. Today we'll talk about ETFs for today's sessions. And if you have any question about unit trust, please hold your question on unit trust until the next session, which is next month. Then we'll talk about unit trust. And two more session later, two more session later, then maybe in month of September we have a recap on all these asset class. Then we may compare unit trust and ETF that point of time. Okay. So this is the disclaimer. What I share with everyone is for your knowledge and information only. It doesn't constitute any financial advice. Do remember everyone's situation is different. Do remember to do your own due diligence. Or if you got any question, you can talk to us separately on that. So now is what is ETF? We're going to talk about ETF. And what actually is ETF? ETF in short is called exchange traded fund. That ETF is a short form for that. And ETF is like a stock. It is like a stock. Why is like a stock? Because it is trade like a stock that you can trade using your brokerage account, just like any stock. So you can treat ETF like a stock that the timing is real time and you can trade even every second on that. But it is also like a unit trust. Why is like a unit trust? As it is diversified. Okay, it is diversified. One ETF, for example, STI ETF invests in 30 stocks listed in Singapore. One S&P 500 invests in 500 stocks. One Russell 3000 index ETF invests in 3,000 stocks. So it's just a unit trust. So, ETF actually is a hybrid between a stocks and a unit trust. And because it is diversified like a fund and is traded like a stock. And this is how what ETF is, and is created due to technology advancement. We know unit trust have been in the market for about 300 over years. ETF only started in 1993. So now it's 2025. So ETF is only have 30 years in the market. So for those that are 32 years in the market, for those more than 32 years old, you may never heard of ETF before 1993. Although there is index, but there's no ETF. It was created after 1993, and one of the key things is mainly due to technology advancement. And ETF have evolved over the years. Until today, the ETF can be very different from the ETF a lot of you have been aware of. And we are talking about what are the new innovation ETF that's coming up in today's market. Yeah, in today's topic also. So what are the key features of the ETFs? And one is diversified through a single investment. Is similar to unit trust. You buy one ETF, you can divest into, as I mentioned, at least 30 stocks, 500 stocks, or even 3,000 stocks. And the investment cost is lower compared to what is always relative. It's always relative thing. ETF is always market themselves as a lower investment cost. One thing is called lower management cost. But that is a not to me not a very fair comparison of that. But that's how the EV market off, and that's what consumer take it as that is. In terms of cost is lower, and you're able to access you to many market by one platforms. I mean, for example, I'm from Philips Security, from Police platform, you can access to thousands of ETF, thousands of ETF in the market on that. And flexibility, you can choose what to buy, and because it's traded like stock, you can buy and sell as and when you like. And some ETF, not all, not all, but majority of ETF pay dividends. Majority of ETF they pay dividends. Can be good dividend, can be lower dividends, can be as low as not even 1% in dividends, can be as high as more than 100% in dividends. Some of you may not be aware. Some ETF pay dividend can be 300%. How they do it, that we'll talk about towards later. That's an innovation of ETF. An ETF, as of today, they are innovated into, they are able to pay you dividend weekly. Okay, do take note, it's weekly dividends. We know that in the past, we want monthly dividend income, you can only buy unit trust. You can only buy unit trust that pay you monthly dividends. There, as and certain US stocks, they pay monthly dividend. But now today, there's ETF that pay you dividend on a weekly basis. And the dividend yield is double digit. It's not single digit, it's double digit. Some can be as high as 20 over percent annualized dividend yield per year. How they do it, we'll talk about that later. Of course, it comes with very, very high inheritance risk. If you don't know about it, you thought that, wow, 24% dividend yield per year and pay me weekly. Well, that's very good for retirement income, but you must understand the risk behind it. It becomes more and more complex. And next is the last one is market risk. That is all investment carry risk. So do take note. There is no such thing called safe investment. As long as investment, it always risk. A lot of people always have misconception ETF is low risk. ETF is not low risk. Unless you buy what money market fund. A lot of them, you may hear of Philip money market funds. I've got it from Philip Security. But do you know that there is also a Philip money market fund ETF listed on SGX? Okay, so that is a lower risk aspect on that, but of course there's always higher risk ETF. That's okay. So we'll try to cover as much of all this tonight into today 2 hour session. And meanwhile, and if any one of you have any question, you can let out on the chat, then I can address it along the way. Okay, so how big is the ETF market now? Since 1993 to today, about 32 years, the ETF market is 14 trillion. And do take note, this trillion, I forgot to put the currency, is US dollar. We are talking about USD. It's 14 trillion in asset. And have grown tremendously over the past more than 1 decade. It can grow more than 1 decade. And you look at number of ETF they call fund count, it is approaching 10,000. It's approaching 10,000. That means there is about 10,000 ETF in the market for you to invest. It is a lot. It's really a jungle out there. The ETF is now become a jungle. Last time it's quite straightforward. Now it's become a jungle out there in the ETF market. Very, very complex. And some of ETF is very, very high risk. You buy already, you may never see capital gain. That's true. Some of ETF you buy already, you will never see capital gain. Similar to some of the unit trust on that. Because of the inherent nature of the way they design it, but they pay you dividends. Okay. So that's something you need to take note on. And we talk less global market. Let's look nearer and what are the top 10 ETF of this close to 10,000 ETF. When we want to talk about ETF, we always look at AUMs. And this is one of the criteria of selecting ETF, which I'll talk about towards the later part. But that's not then take a look on that. Of this 14 trillion AUM of ETF, you look at the top 10 ETF that's in the world. That's the latest. This is one of the latest updates. It's not, of course, not until today lah. Okay, the number one is VOO. VOO have overtake SPY. Some of you may know about SPY. VOO have overtake SPY to become the largest ETF by asset, and this is the AUM. A lot of zero is 700 billions. Billion now we talk about is B, is 700 billions in AUM. SPY very close 647. So that is VO, then followed by IVV, VT. And for those now aware, all these, the top 10 ETF by asset, they are all in the US. So unfortunately or fortunately, they are all traded in the US market. And they are all in the USD. So these are the largest ETF currently in the market on that. Uh, Ray asked why DO take over SPY. That one I don't know because maybe because VOO was lower cost compared to SPY. A lot of investor because VO oil bucket may sell as the cheapest and their expense ratio have been coming down. Initially, their gap from SPI is a little bit now even bigger, although both are very, very low. But to me, I still buy SPY rather than VOO. As you want to trade options, SPY more liquidity compared to VOO. Although VOO is also very liquid lah. Overview. So this is what they are doing. They are always neck on head in head. But anyway, they are still very close. 700 and 647 billions. To take note is billion. And the one coming close to them is IVV. That's under iShares. For those that not aware, what is iShare? iShare is under BlackRock. iShare is under BlackRock. So it's about 635 billions. And that is talking about global, and you can see the top 10 are all in the US. So totally, this is from JP Morgan as of May 19 months. So this is how the ETF have been distributed. Actually, more than 10,000 from here you can see. About 4,800 of the ETF are US. What about US? Are US listed in US. 3,800 are listed in the emerging market, EMEA, and 3,600 ETF are listed in the Asia Pacific region. And actually a bit overlapping emerging markets. So mean they cut off Asia Pacific region, then the rest will be emerging market. So that's how we look at it. Because Asia Pacific is still really a growing region. And Asia Pacific is what including Japan. Okay, do take note, Japan is the biggest. In fact, Japan is the second biggest in the world in the ETF markets after Japan, after US, not Europe. If I'm not wrong, Japan is the second largest. Uh, on that. Okay, and okay, this is based on asset under management, but although it is split this way, but ultimately, US still have the major share, 9.4 trillions. They have about 4,000 ETF listed in the US, is about less than 50%. But when down AUM, they are the dominant player, 9.4 trillion. And where you can see that the Asia Pacific only take about 1.5 trillion and emerging market only 2.1. So ultimately, US is still the dominant player and US is still the economy's powerhouse in the world. So in short, that you want to buy ETF, most people will just have to go to the US market to buy ETF because they are the main players. As why is that so? When it comes to ETF, why most people go to that? Not only on AM, it's also on liquidity. AUM will indirectly translate to liquidities. And this is one of the key factor when you select ETF. We'll talk about that later, but now just to let they have AUM will translate to liquidity. And you want to buy ETF, you want to make sure there is liquidity on that. And which is that's the reason a lot of people go to US to buy their ETF. And let's move nearer and look at Asia Pacific. Asia Pacific region, how is the ETF market? So this is Asia Pacific region. You can see the ETF side in terms of capital size. Japan is the runaway leader in the ETF market, which have about 500 billion, not even trillion, it's billion, 500 billion USD. And you look at the last one is Hong Kong, which only have not even 10% of Japan. In terms of asset is about 48 billion. Okay, that is in terms of Hong Kong. And do you notice something? Do you see that? Do you never see a country that it's not even in the list? Asia Pacific, there's one country that's not in the list. Singapore, correct. Singapore is not even in the list. Singapore. So we are a global financial hub, but surprisingly, our Singapore exchange is too small. Uh, how much is our ETF, Singapore ETF shares? We are not even 1/4 of Hong Kong. Okay, so this is why we are not even 1/4 of Hong Kong AUM. So that is why SGX is challenging, but SGX is still a good stocks. But they are trying to grow. They are trying to go with, and we are not even 1/4. And this is where the Singapore ETF listed in Singapore, and this is the top 10. Where I get this data later, I show you where can you get this data. These are the ETF that's listed in SGX. We're looking at the top 10. So you just look at the top 10. You just look at top 10 by volume. By volume. This is year to date. This is as of I think as of July or May, June, I get the data. You look at the top 10 ETF, you just look at the weightage. The number one, 33%. Okay, 33%. That's not even SDI, it's Hang Seng, that index. Then followed by a REITs, this is 15% volume. Then after then is the another REIT some more, 13%. And where's SDI? SDI is number 4. There's a STI ETF. And we got another ETF called Nikko AM STI ETF. It is ranked number 10. And from here, you look at the total amount add together, how many percent is 33, 40, 50, about 60, okay, it's 70, 80, close to 90% of the ETF listed in Singapore are the top 10. That means what about the rest? The rest, how many ETF are they listed in Singapore in total? I just on the latest count is about 50, it's 50. It's 50. There's 50 ETF. Then the top 10 already take up up to 90% of the volume. So what about the other 40? Share the 10%. Share the 10%. And our AM is 11 billions. 11 billion, and this is this year. Just now I show you the Hang Seng, the data, Hong Kong ETF, that's last year data is already 48. Singapore this year is only 11 billion. So that is, so this is what you compare that. And where to get this list, if you want to know about this list, yes, there is ETF in Europe, but also not ETF in Europe. Later I'll talk about. It's a bit unique. ETF in Europe is a lot of people like to buy the UTICS ETF, so that's a bit unique. But Europe is growing. But you're surprised actually Japan are more advanced than Europe on that aspect. So where to find this data? Since when you go to here, let me just, okay, where to find the Singapore ETF data? Where's the, so what I need to do is you need to go to SGX website. You go to SGX website so everyone can see my SGX website. So you go to securities, you go all the way down to see there's this thing called products and there's this thing called ETFs. And you click on this ETF, it'll bring you to this, what is exchange rate fund, all this. You just scroll all the way down. Then go to this thing called trading summary. Trading summary, you click on it. Then you will have a monthly trading summary posted here. You just click on here. Of course, they got all this full list. You see, I don't like to see this. I like to see trading summary. You click on here. Then you got the latest one, trading summary. Then, of course, I choose the top one. Below is other months one. So you also click the top one. Then you'll bring you to open up this file. Open up this file. And this is as of June. So just now I show you the data is June data, December not, July not out yet. And then you tell the money turnover, then you tell the key ETF data, then you tell you the most active by the month. I look at year to date lah. So this is year to date. So the top 10 is where I get this data from. And then below is the list of ETF here. So you go and count how many is 50. Just nice number. It's increasing. It's 50 now. And the AUM I got, you can see the total AUM in US dollar is 11 billions. And we got another two inverse ETF, which is only 2 million. So total is about Singapore ETF about 11 billion on that. So you want to know about ETF listing, you can just go here, you can have this file. You got all the various data here, like what is the trading currency, what is the AUM local, and what is the expense ratios on all this. So this is where you can get this data on the Singapore side. Yeah. Let me continue. Okay, and when I talk about ETF, right, we can use cash to invest. Just now I show you all the 50 ETF. You can use your cash to invest. And what about using SRS? If I'm not wrong, majority can use SRS to invest, even if it's in US dollar. Almost majority can use SRS to invest because SRS are always treated like share, like cash. It's your own money. But CPF, what are the ETF can you invest in? Of this 50 ETF, there's only 6 you can use your CPF to invest in. So 6 out of 50. So slightly more than 10%. But in fact, you can only say it is also around 10%. Why is that so? Is there's this thing called SPDR Gold ETF. Okay. You are subjected to only 10%. 10%. That means your CPF OA, you can only use 10% of the money to buy this gold ETF. And do take note, it is in USD. Yeah? It's in USD, so you need to convert. So the other 5 ETF, how much what is the limit you can use for you to invest in CPF OA? We know that for stocks is 35%. Okay, 35% for this gold ETF is 10%. The rest of the ETF you can use 100%. Okay, do take note. You can use 100% of your money in your CPF OA to invest, but you must less off the first 20K. Less off the first. What does that mean? Means that let's say you got 50,000 in a CPF OA, you just need to less off 20,000. 30,000 you can 100, you can all go inside to buy this 5 ETF. So it is like unit trust. Unit trust also same thing. The first 20,000 cannot buy unit trust. Anything above 20,000, 100% can buy unit trust. So similarly for this 5 ETF. So these are the 5 ETF that you can use your CPF OA to invest. But do take note you can use a CPF OA to invest doesn't mean you make money. Doesn't mean you make money. So do take note of this. And happen to be this year is a good year lah. Happen to be this year is a good year. One more performance STI up 16%, all this. Then the bond even up 9%. But I look at 3-year performance, 0.14, 1.6. You buy these two, it is better to put your money in CPF OA. STI 3-year is so high because now it's at all-time high. You buy REITs, negative returns. And so the one to look at only worthwhile is like STI, it will be better than 2.5. But how much better, that will depend on the market itself. So that's something that you will need to check on that. Okay. So this is on the CPF OA approved ETF. And so before I buy ETF, you must know that who are the party involved in the ETF, how ETF is being sold, and who are the person involved in the ETF. Okay, so first thing, you must have a stock exchange. Okay, like Singapore is the SGX exchange. So it is the one that provide the platform for the ETF to be listed and to be traded. So the ETF it's just like a stocks, they must be listed. Uh, so this is something a bit confusing. When you talk about stock listed, it is called IPO. Okay, when the stock is listed, it's called IPO, initial public offering. So that's called IPO. But when an ETF, okay, uh, is listed, it is called IOP. So the OMP swap, okay, OMP swap is called the initial offering period. So initial offering. So a lot of people have a misconception of, I think our ETF listed is IPO. It is not IPO. It is IOP. So there is no need to, I also kind of don't need to rush to buy a new ETF that is listed. You have to remove that stock investment mentality when buying a ETF. Well, when a stock IPO, a lot of people have the mentality, oh, I buy now, then trader, if gap up, I can sell, I can make the money. It becomes like a speculation play for stocks. Okay, but for ETF is different. It's an initial offering period. You will not get gap up on day one when they listed. Why you not gap up? Because ETF is buying a basket of stocks that are currently trading at today market price. It's not something new. It's not new stocks that are going to be in the market. So they just take the money to go to the market to buy all the stocks in the market. So when they are currently offering, the price will not get up one because it still follow the whole market movement. Just like if let's say it's a new STI ETF going to launch, it's an IOP, you know, don't need to go and rush in to buy this new STI ETF because when listed STI ETF will not get up. Will not give up. So that's my that, and in fact it may come down. It's because it follow the market. So there is no rush to go in to buy a new ETF listed. In fact, I usually don't buy at all. I usually don't buy at all. Why is that so? Is that it's just that I don't buy a REITs that's just IPO. Because it's not tested. You also don't know. And you see when an ETF is launched that time, is that market is a bit hot. Then people want to buy ma. And the market will be hot, means that the stocks, underlying stocks will be all on a high price. So you are going to buy all these stocks at maybe high price, and some of them may be all-time high at history high. So actually you're buying at a high. So don't need to rush for an ETF that is listed, but we need an exchange to list the ETF. Then of course, then there's something called fund managers. All ETF must come with the fund managers that manage the ETF that manage the ETF. So, like for example, Philip Capital, Lion Global, a lot of people may heard of like iShares, BlackRock. They are all the fund managers that manage the ETF. And you see, they will track the index. They will track the performance of the index on that. And then, of course, there's something called participating dealer. There's a called participating dealer that will create and redeem ETFs units with a fund manager. So what does that mean? Because for ETF, it's not like stocks IPO. When a stock IPO, the company say, I'm going to list 40 million shares in the market. So the buy and sell can only be 40 millions, for example. And the share will reduce if the company do a share buyback. The US stock counter like to do, they always do a share buyback to reduce the number of shares in the market. Okay, this is one way and one way of pushing up the share price. This is one way of pushing up share because the number of shares in the market is lesser, so the demand is the same. the supply come down, so the price will go up. And thus, you always say that when the company issues a share buyback, the share price will go up because of demand supply dynamic. But ETF is different. The more people buy doesn't mean you'll go up because ETF is is created from, you can say it can created from the air. Okay. So when there's people buy, when they launch an ETF, there's no zero units. So let's say you put in $10,000 to buy an STI ETF. So there's no 10,000, don't have ETF in the market. You go and put in 10,000. What they do is the participating dealer will take your $10,000, then give you, let's say $1. Then they give, I give you 10,000 units of ETF. They just create 10,000 units of ETF for you. Let's say you sell off 5,000 of ETF, we call units or shares, and nobody buy from you, they take from you, and they take this 5,000, then they what? Dissolve it from the market. Then this 5,000 units of ETF will disappear from the market. So that's how ETF works. It can be created and redeemed if there is no buyer or seller. That means there's nobody buy from you, nobody sell to you. It's the dealer that just buy and sell from you. Then what they do, they are not going to hold the ETF for you. They just dissolve and create. So that's how an ETF works. And then, of course, then there's a market maker. The market maker will constantly preview you the buy and sell price to make sure that it's available. For example, I'm from Philips Security. Philips Security is the market maker. You see, most of all brokerage firms are the market maker. They produce it the bid and ask spread to make sure that there is a constant liquidity. That means you want to buy, make sure someone will be able to buy from you. No, don't have. The market maker will talk to a dealer, then they create and sell it to you. So that's how, and then of course, then there's always custodian and trustee. As it is a fund, just like unit trust, there's always something a trustee that will approve the creation and redemption of unit. So these are all the party involved in the ETF side, where you got a market maker and you got a dealer to create and make sure that it's liquid, there is sufficient liquidity available in the market on that. And this is how it works. This data are taken from SGX. Okay, this is the SGX data on how ETF work. So first is that when you want to buy an ETF, let's say you want to buy an ETF, you are the buyer, you want an ETF, then there must be a seller, correct? There must be a seller. So just like you want to buy OCBC said, you want to buy, someone must sell to you. So it's a transaction. Transaction, you give the seller take back the cash, then give you the shares. But what happens if there is no seller and you want to buy? Will you still get it? Yes, you'll get it. Why? Because the participating dealer will sell it to you. How they sell it to you? They go and talk to the fund manager. Hey, there's someone want to buy, but no seller. How can you create more? Then the fund, okay, can I create more? Then they create the units pass to a dealer, the dealer pass to you. Then same thing, the cash you pass to a participating dealer give to the fund manager. Fund manager will say that they give them securities. And this is how it works. Similarly, for selling, when you want to sell, there's no buyer. When there's no buyer, same thing, the dealer and the fund manager will come out, then they create and on this. So this is how a ETF is being done. And when there's no real buyer and no real seller. Okay, so that's how the ETF market has been working all the while. Uh, the dealer, yes, participating dealer is they'll work with the fund manager. For example, Philips Security is a fund manager, then it's a market maker, and you see they are the participating dealer. And they work with the fund manager to create all these things up. So that means you are betting against those market player on that. So that is something, to me, that is something not that ideal on that. Market maker, a lot of people, some people have bad comment on market maker. Uh, because market maker should make money, one. Okay, so money cannot create from thin air. Someone make must be someone losses. Okay, so this is why everyone want to be a market maker because market maker will sure make money. How they make is through the spread. How they make is we'll talk about that later. And this boils out to you want to choose ETF, you need to be careful on what ETF to choose. There are certain criteria on that so that that will minimize on that. That's called the secondary market. Okay, so then of course there's a primary market where institutional investors enter and create and redeem. That's another market, but we are talking about secondary market for us. Okay, and next, so how the ETF work? The original ETF objective is index tracking. Is index tracking. That's the original objective of ETF. It's just follow the index. Since 1993 startup, they just follow index, follow STI, follow S&P 500. The market go up, you'll go up. Market come down, you'll come down. So they just follow the market, and a lot of people call it passive investment. It's really passive. They are following the market. That's the original concept of ETF. But and how they do it is that first there is something called full replication. What does a full replication means that STI ETF, for example, you got $10,000, you go and buy a STI ETF, and you are given 10,000 shares of STI, let's say $1. So when this $10,000 go to actually go to the fund manager, and the fund manager really take your $10,000 to go and buy the 30 STI stocks as per the index competition. Like the banks will now contribute more than 50% as their ETF. They take more than 5,000 money to buy the three bank shares in that order, in proportional. And this is what I call full replications. So what does that mean? The ETF you hold now is really got the stocks, 30 stocks behind them one as a real backing. So it's not something fake one. It's really got the stocks behind them. And 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 this is what ETF is on that. And there's a conspiracy theory so that say that ETF become more and more popular actually create more risk to the market on that. But that one we're not going to talk about that today because that's a theory only. Whether it happen or not, nobody knows. And next we call representing sampling. What does representing sampling mean? Means that they take your $10,000, same thing for to buy STI ETF, but they maybe only take 5,000 of your dollar of your money to buy the stocks instead of the 10,000. So that's called sampling. They did not take a full amount. So your ETF is not really backed by 100% of the stocks. Maybe only 50%, maybe 70%, and 30%. That depends on how they structure it. So it's not a foolproof stock. You don't really have 100% of stock backing. So that's called representative sampling. And another is called synthetic replication. What does synthetic replication means? That your $10,000, you don't even have a single stocks. Okay, don't even have, they just use financial derivative. They just use, so in a way that it can be risky because it's synthetic. Synthetic means not real. They just use some derivative instrument to do it. So there is always something called a counterparty. Counterparty means someone will guarantee they will deliver. But if the counterparty don't deliver, then your ETF can become zero. So that's called synthetic replication. Just to throw back some history, like Lehman Brothers crisis, the mini bond, they say they got buy what Singtel, Capital Corp, DBS, the bond, but actually they don't really buy any bonds from them. The mini bond got zero bond behind them at all. They are using synthetic. They are using derivative. And who is a counterparty? Lehman Brothers is a counterparty. So when Lehman Brothers go bust, you hold the minimum become worthless in a way because there's no bond at all. There's nothing. And go and look for DBS, look for Keppel, or look for syndication. Don't have nobody buy from them at all. So that's called synthetic replication. So it is can be more risky, but why it is still available in the market as certain ETF no choice have to use synthetic. For example, oil ETF. You buy a crude oil ETF, you don't expect the fund manager to go and buy oil and put in a oil storage tank and keep the oil for you. There's no way they can do it. There's no way they go and buy soya bean commodity, especially a commodity. You don't buy wheat. ETF. You don't expect the fund manager to go and buy wheat and find a place to store the wheat. Don't have. So they're using future contracts to do it. And thus, it has to be a synthetic replication. Cannot be real one. Cannot be real one on the aspect. And thus, the risk can be higher. Okay, so that is how a synthetic. So that is how this is what we call the first two we call a cash-based ETF. So it's very, very transparent. So a lot of people say that ETF is very transparent. Yes, if it's a full replication, of course, very transparent. There's limited counterparty risk. But you buy synthetic one, actually the transparency is very lower. It's not no transparency, it's lower because they are using derivative and collateral on that. So some people tell ETF is very transparent. Yes, it's transparent. It's not 100% true. If they are transparent, they are referring to full replication ETF. When they talk about a lot of people tell you ETF, they are talking about STI ETF, S&P 500 ETF. That one is a full replication. So of course, very, very transparent. But they tell you about what soya bean, wheat ETF, actually they belong to the synthetic. So that's something you need to take note on the different aspect of ETF. Okay, how do you tell which strategy the ETF adopt? Uh, so USO and PNO, you can go and look. Of course, for oil, you see, definitely have to be synthetic because they can't store the oil for you. There's no way they will store the oil for you. How do you know? That's how Eng Chong asked, like, which strategy they adopt. This one you need to look at the prospectus. Prospector, they'll tell you. And but to be honest, I think nobody invests in ETF read the prospector. I also never read the prospectus. Or you can read the fact sheet. They will give you show you some color on that. So at least you know what they are. At least you see fact sheet, they'll tell you they are synthetic, they are full replication or represent sampling. If most of the fact sheet will tell you that their ETF belong to what category on that. Okay, so this is a view of how those ETF work. There is direct replication, replication of full replication representing sampling, or they got synthetic where they use derivative or they use swap. So this is how the ETF work. And these are the real example. Actually, all these are last time taken from SGX, but now I think you can't find all this detail in SGX. They have removed that on this. So this is how that work. Okay, full replication, they really buy the stocks. So you talk about ETF, you want to buy so-called safer ETF. Of course, a full replication ETF will be the safer as they don't really have counterparty risk. You really hold the physical stocks. They really hold the physical stocks for you. And they really hold it for you. So, and this is how representing sampling is. They will but hold a portion of the stocks for you, not 100%. Okay. And the derivative embedded, this one a bit complex. So they got some collateral, they got issuer. So that is a bit complex called the derivative embedded ETF. And now of course then you got a lot swap-based ETF. So this some of the complex form of ETF. On that there's a swap agreement. So when it comes to derivative and swap, there's always a risk called counterparty risk. You must know who is the counterparty. And you see they'll state in the prospectus who is the counterparty. So you really want to you invest small amount, of course, no need to bother about, but invest in big amount, then better go and check who is the counterparty, make sure the counterparty is you must also know the counterparty financial statement in a way. Okay, so what are the risks? Key risks of buying ETF first is market risk. That is quite standard, everything that is market risk. Next is forex risk. As I show that STI ETF, Singapore only got 50 ETF listed. And of these 50, not all are in SPD some more. So we are in Singapore. So you want to buy ETF, especially you go to US market to buy, you are exposed to US dollar. And for those that invest in US dollar, US market, you may have feel the pinch of it. US dollar have dropped against Sing dollars. I think close to 10%, high single digit this year already. So if the US ETF, the ETF you buy, go up maybe by 5%, but you convert to Sing dollar, you lose money because the forex loss is more than the exchange loss. But if your ETF buy up 20%, you convert to Sing dollar, you will not make 20%. You need the less of the forex losses. And of course, a bit of a spread. So there's always something called a forex risk when you buy on that. And not to forget that even you buy ETF in Sing dollar terms, but the ETF is not invested in Singapore. For example, the CPF OA approved REITs ETF that's invest in Asia Pacific region. So they'll buy REITs listed in Hong Kong, which is in Hong Kong dollar. They'll buy REITs listed in, let's say, Australia, which is listed in Aussie dollar. So you are indirectly exposed to forex risk also. Indirect for unless you buy those ETF that only buy into Singapore stocks and all the Singapore stocks are in SGD, then of course you don't have forex risk. So sometimes forex risk is unavoidable when it comes to investment. It's just that how you're going to manage it, how many percent should be in SGD, how many percent should be in foreign currency. That will depend on how you want to manage it on that. And next is liquidity risk. We'll talk about that later. Very, very crucial when it comes to investment, as that will affect your returns. And tracking error. So this is a very common thing for ETF. There's always tracking error. What do you mean tracking error? ETF, let's say STI ETF, they buy 30 Singapore stocks. But there always a buy and sell. There's always a transaction. There's always a time lag on that aspect. So the STI ETF may not perform exactly as the STI. There may be some deviation. Of course, if less of the management fee, that's always the different in return. But they can be sometimes better and they can be sometimes less. They can be sometimes more, they can be sometimes less. That will depend on other factors, and that is why I call a tracking error. When the track index, as it is not really, they can't be 100% real time on that, especially when the volatility get higher, very much many buy and sell on that. So, but you see, it will be all big ETF. You see, the tracking error will be very, very minimal. You can't really feel it lah. But that's something on that. Unless you big amount, then you can feel it. And next is a bit ask spread. This is something that we will talk about later. And this is linked towards the liquidity side, the bit ask spread. And next is a counterparty risk, as I mentioned. That's mainly for synthetic ETF, as the counterparty, if the counterparty don't honor, your ETF practically become worthless. And then the collateral risk also, the collateral don't work. Similarly, your ETF will also become worthless on that aspect. So that is on the risk of ETF aspect. And next, we're going to talk about this thing called, because of that, there is this thing called SIP and EIP for that thing. Because of the complication of ETF. So a lot of people thought ETF is quite simple. It's not really that simple, depending on what you buy. So MS have to come in and step in to tell you that some of the ETF will be under this thing called SIP. SIP is called Specific Investment Product. So only who can buy? Only can only be sold to retail investor with enhanced safeguard. So that is what I mean by that. And EIP is exempted investment product. Anyone can buy. You are uneducated, you have no financial knowledge. As long as you got a brokerage account, you can press button and buy. So that's called exempted investment product. But special investment product, even you are a degree holder, but not financial trained, you are not allowed to buy unless you pass the assessment. Then you can buy. And this is what SIP and EIP means. When they start this program, I think it's after global financial crisis, MAS start to have this law. I think it's about 2012, then they start to implement this thing. And when they start to implement this, they are implement on who, on what? On unit trust and ETF. Stocks don't have. Stocks, whether you know or don't know, as long as you got brokerage account, you can buy. You can buy lousy stocks, you can buy junk stocks. The one is your problem. But when it comes to ETF and unit trust, majority of them are classified under SIP, even a very, very low risk unit trust. Okay, over the year, MS have relaxed the rules and start to have more and more EIP. Some of them, like for example, STI ETF is under what? Under EIP. For those not aware, STI ETF is under EIP. But let's say you want to buy SPY. SPY is actually a full replication ETF, right? But because it's traded in USD, it's traded in US market, MS classify them under SIP. Means that you don't have knowledge, you cannot buy SPY. Okay, you cannot buy SPY. So that is what is happening. But over the times, over the years, MS have evolved. But I do think that this SIP, EIP is only as per now, and there will be changes to this uh, soon, maybe in 1 year time. Maybe I share with you what will be the changes so that you'll be informed on what is going to come forward. MAS have decided, okay, to go and change the SIP and EIP system. Uh, some of you may heard of it, some of you may don't even aware that it's changes. This is from July. This is July, you all can see. The MS want to change things in the always some of the company in this consultancy paper ask you to feedback, see whether would this work or not. So they're going to have this thing called complex product framework. So they're going to have this thing called complex product framework. So you want to feedback, you can also feedback by September, your feedback. So what I want to highlight to you, this is a very long page. So I just want to go down to the bottom. So this is a summary of what will going to happen. What is going to happen? Although it's a consultation, but sure happen one. In a way, nobody will object. Especially the investment institution, they will not object because it's to their advantage in a way. So will be the new regulation that I think maybe may enforce next year. I don't know the timeline, is it when? They say that let's say you want to buy a complex product. They no longer call SIP. Okay, they are called complex product. Let's say you want to buy USO. Let's talk about USO, oil index. So now you want to buy USO, first you must pass CKA. The CKA pass, you say that you don't have financial knowledge, you must go to SGS website to take a quiz, to go through a set of training, online training. After online training, you must pass the exam. After you pass the exam, you must send us the cert. I'm the stockbroker, you must send me the cert to show that you passed already, then you can buy. But your cert got validity date. 1 year, if I know it's about 1 year or what. After 1 year, you are considered expire. If you never trade, then you need to retake again. Okay, so it's a constant thing. But now they're going to change the framework, say that if you want to invest in a complex product, okay, as long as you're not vulnerable are people that are old, uneducated. That's called vulnerable. Because 40 years old definitely is not vulnerable. Software engineer, someone. Okay, but you fear the knowledge assessment. You fear, you no need to take test already. You need to take test. You just need to acknowledge. You just need to say, oh, I know the risk. Click yes, you can buy already. So they make it easier for investors to buy now. Going forward. I mean, a lot of people, so troublesome. I need to go and take test after must send the cert, then must fill the form. So next, the new one is that you can straight buy that. But this thing can subject to change because this got a consultation paper. If a lot of people feedback say no, this one not supposed to be that way, then they will take their suggestion on that lah. But I think whether people object or not, that will depend lah on that. So that is will be what will be the changes going forward. But this is not a final version. This is just this is what they propose for non-borrowable kind, non-selected kind. But of course, for borrowable kind, then will be different. Borrowable kind will be still need to subjected to a lot of things. But most people are are not considered non-borrowable kind. So that will be the new regulations that coming in soon. When it implement, we will know it maybe most likely will be for earliest will be next year lah. Earliest, that's the earliest will be next year. Definitely not this year. So currently we still need to stick to the SIP and EIP framework on that. Yeah. Hyperboss, no need to pass the test. That one that beyond me. That one try need to talk to MS directly. Okay. On that. Okay. The way they look at their risk management is a bit different on that. Just like CPF, the risk but the one they are the authority. We got I got no right over them. We got no right over them. They decide on that. Okay. And I cannot say much on that. Okay, so now let's talk about. So these are the basic ETF on that. So I think before we go on other more complex ETF, since now we take a break first. We take about 10 minutes break, 9:05. Then come back. Then I'll talk about the more complex ETF and also talk about how to choose the ETF. Okay, so we come back at 9:05. I hope everyone is back already. Okay. I will assume everyone is here, so let me just continue on the ETF side. So, and as I mentioned, the ETF started in 1993 with the intention of tracking the index, and that's why it's called passive investment. And Warren Buffett has said that you don't know anything about investment, you just need to buy the index fund, which what I mean is buying S&P 500 ETF. As we know that S&P 500 ETF is a positive buyer index. When we have positive bias, you have to go up over long terms. So you don't need to do anything, just buy and follow the market. But over the years, especially over the past few years, from COVID to now, and especially now got AI coming, ETF has started to innovate themselves. And when you always talk about ETF, we are talking about ETF is passive investment, unit trust is active investment. Okay, so now the market has started to change. That means that for ETF, it's now become more than passive. It's more than passive. There's many different type of ETFs start to come out. And for unit trust, they also start to from active become passive and can be even cheaper than buying an ETF. And performance same as an ETF, has become passive but at a lower cost than ETF. So unit trust also evolve, but we're not going to talk about the unit trust aspect. We'll talk ETF. ETF has also evolved. So one of the evolve of ETF is become called actively managed ETF. So what does an actively managed ETF? That means the fund practically have to go. Okay, is to what? Outperform a benchmark. As I always mention, the ETF never outperform the benchmark one. They are following a benchmark and are always underperform because there's always a cost incurred. But now there's a group of ETFs say that their intention is to outperform benchmark, just like unit trust, and able to access to certain market that is niche, that's niche one. And thus, this ETF although have a benchmark, but the fund manager may change as and when they like. Because ultimately they want to outperform the benchmark. So it will give you a returns that do not perfectly, the keyword is do not perfectly mirroring the index. The not perform mirroring the index anymore. So that's why I call that actively managed ETF, which is gaining a lot of popularity in that. And they are usually on the sector that high volatility, they are one that are more on that. So what are the example of active managed ETF? This is a actively managed ETF. Okay, another one is not inside the list because I saw it based on the top AUM. Another very popular actively managed ETF is ARKK. I think everyone know about Katie Wood. So her is one of the more famous actively managed ETF after COVID, Katie Wood. And now actually he's still very popular. A lot of people still looking at. And these are some of the active managed ETF. For example, the one now gaining a lot of popularity is this one. I'll talk about this later again. Because this is not only active managed ETF, it's also a high dividend ETF. They call it JP Morgan Equity Premium Income Fund. So all these are active. So these are examples. Even dimensional US market ETF. Dimensional, a lot of people talk about their unit trust, right? They are also ETF. So you buy a dimensional unit trust, actually you can buy equivalent dimensional ETF in the market. Just like you buy Philip money market funds, right? When you have points, you can put inside, you also can go and SGS have brokerage to go and buy Philip money market fund ETF. So you see, have two one. Dimensional US core equity ETF. There's also a dimensional US core equity unit trust on this. So they serve two. That's an ARKK. ARKK is an ETF, but there's an ARKK unit trust fund. Some of you may not be aware. There's an ARKK unit trust fund. Actually, is ARKK. Buying exactly the same thing. It's just that they are packaged in a unit trust. They are registered under unit trust category and in Singapore, and they are in exchange dollar terms, SGD terms some more. Okay, so that's how I actively manage ETF. And so then we got this thematic ETF that's also actively managed as they are based on theme. For example, they talk about infrastructure. I share global infrastructure. So what they do is their theme is on infrastructure. They buy into infrastructure, like this one, expanded technology sector ETF. So it is something like a unit trust, but they are a bit different already. Okay, like this one, Uranian ETF Global X, they're buying on global nuclear energy. So these are thematic ETF and they are actively, some of them are actively managed. Then they buy and sell shares on a regular basis. For example, if you subscribe to ARKK newsletter, I think you receive email every day on what are the shares he buys and sell. Daily basis, buy and sell on a daily basis. But of course, not all. You just buy, sell, buy, sell, buy, sell, buy, sell. Okay, so that is on the thematic ETF. So this is what currently there's in the market. And next, another thing coming to the market is called smart beta ETFs. What is smart beta? Smart beta ETF are ETF, they just follow a rules. They just follow a rules. They follow a rules to approach to choose a stocks from a particular index on that, and they don't follow the index. They don't follow the index rules. They got their own rules. So this ETF can be active and passive. Because they are called rule-based investing. Rule-based investing, the objective is to give you a better portfolio return, maximize dividend, and lower your portfolio risk. So that's called smart beta ETF. And these are the example of smart beta ETF. Like for example, Vanguard Growth ETF is under the smart beta ETF category. And like even I share Russia 1000 growth ETF. So they are got a rules based on it. And you want to know their rules, what I need to do is you need to go to their prospectus to state, they will tell you their rules. Why they buy this, why they buy that. But you can see that their AUM is not really that big. It's not really that big, it's relative. It's relative to compared to the top ETF, of course, they're not really big, but in terms of size, actually quite big, 180 billion USD. 61 billion USD is big, but compared to the top 10 ETF that are all passive ETF, they are too small. They are too small. Like Vanguard High Dividend Yield Index ETF is about less than 10% on as VOO, but it's still very, very big, 61 billion. Do think that Singapore ETF market AUM is only 11 billion USD. So this, for example, Vanguard High Dividend Yield ETF is six times bigger, 5 to 6 times bigger than the Singapore ETF market as a whole, one ETF itself. Okay, so that is what you mean by smart beta ETF. And this is something that is very, very interesting, which actually is a post-COVID ETF. It's a post-COVID ETF in the market 3 years. Some just launched this year. More and more of this ETF coming is called a cover call ETF. For those that are not aware what is cover call is an option term. So this ETF use options. The ETF give you extra income by doing cover call. Okay, so it is so-called inverted comma options ETF. It's an options ETF. And so they are selling stocks and they are not doing naked call. Do think most of them don't do naked call, but some do. Some do. So you need to be careful on the selection. Naked call is very, very risky. Most of them don't do naked call. So what they mean, they really hold the stock, then they do the cover call. And because of that, they tend to generate higher yield. While selling options for income, we're able to get income. A lot of people like to do options for incomes. So that is what they are mean by that. There's getting more and more and getting more and more complex. This is just a few examples. For example, JEPQ, which is very, very popular. You look at their dividend yield, 11%. 11%. You look at this one, yield max MSTR option income strategy. What is the dividend yield? 130%. Okay, so you look very yield max ultra option income strategy, 118% dividend yield. And do think that all these cover call ETF, most of them pay dividend on a monthly basis. Monthly basis. Some pay weekly. Some more and more pay weekly. And for those want to buy Bitcoin, Bitcoin high income ETF, 19% dividend yield. So that is something okay, but please don't go in and buy this type of ETF unless you know what you are doing, what you are doing on that, and you must understand what is the underlying thing. And there's a one that getting a lot of popularity. I think this one just launched less than one year. Is this one? Okay, and in fact, it's called OMAH, but the yield is very low. What do you do? They target only buy Warren Buffett, Berkshire Hathaway, they're holding. They look at what they buy, what Warren Buffett buy. They pick 15 stocks and do cover call on the 15 stocks that Warren Buffett buy. So a lot of people follow. Wow, Warren Buffett one, Warren Buffett one. So everyone just blindly jump in and follow. Even in less than 1 year, you can. Because I based on I said it can garner so much AUM already. So this is called a cover call ETF. It is can be very risky if you don't know what is it. I don't want to mention name on that. Some of the ETF, single stocks ETF, for example, just buy NVIDIA, give you 83% dividend yield. Okay, but do take note, do take note. This is talking about dividend yield. In here, never show you what is called the total return. Okay, total return. Some of them is negative. Some of them is negative. So positive distribution yield doesn't equal to positive return, similar to unit trust. So please don't go and see, wow, 130%. Wow, every month I got 10% return no, on dividend. I go in and buy. But you may lost 50% of your capital. So that is something that's the thing, and this is what is getting a lot of traction. A lot of people like to buy this type of ETF, and I myself got one. I buy one. I plan to buy another one. On that, all this inside, I myself hold one. I plan to buy another one or two. Uh, I know what I'm doing, so it's a bit different. If you don't know, and you must understand what is the option, and you must understand what they do on the options. And you also need to know when you should buy, especially at this market juncture. He asked me, should you buy? I say, you should not buy. At this market juncture, I don't think you should buy. So I say I plan to buy, but I did buy. Because at this market juncture, it is too risky to buy this type of cover call ETF on that. How risky is a cover call ETF? As I mentioned, some of them total return is negative. Total return is negative. Okay, one example is, let's say since we are here, I just give you an example. So let's say they buy these stocks, NVIDIA. Let's not talk about NVIDIA. NVIDIA. And we know NVIDIA keep on go up. So what they do a cover call ETF. They say now they buy NVIDIA at this price, they do a call here to collect the premium. And you see it's 1 month. 1 month later, if NVIDIA go up higher, the NVIDIA share will have to be sell away. Alright, sell away. Then what they do? They need to go to the market to buy NVIDIA at this price. Then they do a call here. Then what happens? NVIDIA go up again. The NVIDIA share sell away. Then they need to go to the market to buy another NVIDIA. Then do a call here. So you see the danger. What happens is the share go this way. Okay. So thus at this current market juncture, it can be quite risky to buy a cover call ETF at this juncture. So you get the dividends, but and do think no, this cover call ETF, the longest history one, I think is only about 3 years. And you know, the past 3 years, US market have been doing very well. So they don't have a long term. I think got 5 years one. Yes, there's got 5 year one, but don't have a too long term track record. So there is no long term track record. How are they going to perform in the bear market? Okay, how will this ETF cover call ETF going to perform in the bear market? So it's an unknown. And will some of the ETF close short when they hit by a bear market? It also unknown. So that's something just to take note. Please don't heard people tell you that, wow, dividend yield so high, just go in and buy. You must know what you are doing on that. Okay, so that is what the cover call ETF now. I think I need to share with everyone that these things, in case that you are not aware on this, a lot of retirees thinking of buying it and given weekly income some more. Okay, so next is leverage and invest ETF. So that is another type of ETF is that the leverage for you. And if the index increase by 2 times, you make 2 times, you make 4%. And inverse is that index drop, you also lose money. So that is called a leverage and invest ETF. Do we have leverage and invest ETF currently in Singapore SGX? There is. Let me see. Let me see. I can show you what is the leverage and invest ETF. Okay, here. You go to this list here, you were able to see here, leverage and invest product on SGX. There's two. One is called the MSCI Singapore Daily 2-time Leverage Invest Product, and one is called the MSCI Daily 1-time Invest Product. What does it mean? That is a Singapore market, but it's not STI, it's MSCI Singapore. So a bit different now. STI and MSCI Singapore is different. It's different index provider. This is MSCI provider, and MSCI got another ETF called the MSCI Singapore Index ETF, which is not popular among Singaporean, as a lot of people don't even aware that is this. This is the one. Extractor Singapore UCTIS ETF. Compared to that, the STI Spider STI ETF, a lot of people know, right? But this one, the stock code is D9. So this is the index. This is the ETF that track the MSCI index. And this is the ETF that 2 times the index. And this is the one that minus 1 time. But so what does it mean? It means that if the MSCI were to, Singapore MSCI index will go up by 10%, this ETF will go up 20%. But if Singapore index will be down 5%, then this ETF also will give you plus 5%. Especially now Singapore market all-time high, a lot of people say, I want to short the market. This is indirectly in a form of called shorting the market. So that's on the Singapore SGX only got two lah. But US got a lot. US got a lot on this. So this is called a leverage ETF or invest ETF. Invest ETF. But do think note this product is very, very risky. Very, very risky. Because it is based on daily reset. Okay, it is daily reset. So it is not meant for you to hold long term. Okay, it's not meant for you to hold long term, especially those short one, those short position. It's not meant for you because you will not deliver the stated objective more than 1 day. For example, the MSCI leverage ETF 2 times, right? It's leverage MSCI 2 times, right? But I hold this index for 1 year, right? MSCI Singapore index go up 10%. Your leverage 2 times may not go up 20. You see, it's lesser, maybe 18. Because it is based on something called daily reset. So that is something you take note. And task leverage and invest ETF is for short-term trading, not for long-term investment. On that purpose. What does it mean? Let me just show you the risk. The risk involved is that because there is always a risk that they may not, especially for short, right? They may not able to carry out their short selling strategy. Sometimes they can't even short, depend on market liquidity. If for those that do trading, you may know that if, let's say you use CFD, sometimes you want to short the counter, right? They tell you no script, you can't short. So you also can counter non-script as a retail investor. Fund manager also can encounter non-script also for shorting certain things. So that is something to take note. So if they cannot do it, then they may cause them to trade at a premium and discount. So that is a risk involved. Just show you an illustration. This is example. You will invest $100 into this is funny a simple fund. This one is two time leverage this index, this shorting this index two time on the two-time leverage. And let's say day one, the market got 10%. Your this index will what? Will give you $100 become 110. Your two-time will become what? 120, 20%. Your inverse will become what? $80 because you lost 20%. Go up 10%, you mean lost. So it become $80. So that is simple math, right? But then this is on day one, which always counted on day basis. Let's talk about day two. If the market is volatile, today up 10%, tomorrow down 10%. What will happen to the index? It will become $99. Because 10% of 110 is $11. For those that don't see the math, it should be minus 11 become 99. So 120 become 96 because minus what? $24 times 2. Right? But this one got negative 10% means up 10%, right? Times 2 plus 16. We got 80 times 20%, become 96. So you can follow the math. So this go one day up, second day down. Then after 6 months, let's say today up, tomorrow down, up, down, up, down, up, down, up, down, down, every day swing. 6 months later, the index actually lost only 5%. Correct? But your long one become what? It lost more than 90%. And your short one it lost more than 90%. But actually the index only down 5%. So that is what we mean by leverage and invest ETF. It is not for you to buy and hold long term. Over the long run, the market actually after 6 months only from here down only 5%. But your ETF lost 90%. Whether you long or short. Why is that so? Because it is the keyword is called daily reset. That means they realize your profit and loss on a daily basis. Compared to this simple index is a buy and hold. So that is a risk of a leverage and invest ETF, especially for volatile market. And let's look at comparison. Some say that, oh, what about I use CFD? So this is a comparison we're using CFD. CFD you can short 5 times, you can long 5 times, you can even use 5 times leverage. 5 times leverage, right? But achieve CFD, you can use up to 20 times leverage. 20 times. But index ETF is only the most is 3 times. So far I only see 3 times. I didn't really see 5 times before. So this is 5 times even more risky, right? So let's look at the chart. And this is real this is real calculation. Day zero, everyone start with $100. Then day two, day three, day four. Let's talk about under day five. You talk about volatile market, like wow, 23. That's certain stocks because individual stocks also got inverse. Just I show you, like even Nvidia, even Google, there's 3 times Google ETF for those that are not aware. You think Google next result coming out going to Google going to get up? You don't buy Google share, you go and buy Google 3 times index. Because Google up get up 10%, you make 30%. But Google get down 10%, you lost 30%. Individual stocks also have that. Especially the popular Tesla, Nvidia, all this got leverage ETF on their own. On their own. So if it's a volatile market, you look at it at the end of the day, if you just buy a normal ETF, right, actually you don't lose money. It's flat. Actually, come back to square one. If you use a CFD you to short, you don't really lose money. This is excluding the interest. This is excluding the interest you pay. You use a long, you also don't lose money. But imagine you buy an inverse ETF, you lose money. You buy a three-time leverage ETF, you lose even more money. So for this case, look like CFD become a safer thing for longer term compared to doing inverse ETF. So this is something I just want to share in case some of you say that, hey, I want to buy those ETF because it give me better long-term return. Unfortunately, it's not this way. Okay. What about a lot of people say, what about safe market, for example, like S&P 500, SPY? So this is a chart. This is a chart of S&P 500. You can see this is SPY. This is SPY. So SPY over the past 1 year have went up. Okay, went up. I'm using SPY as a reference. Uh, okay, SPY as a reference. I see where it went up, right? Okay, this is including, okay, has went up. But I look at SPXL. SPXL, for those that don't know what is SPXL, is three times S&P 500. It never go up 120%, no, it only go up 90%. And SPXS is three times short S&P 500. SP, it down how much? Close to 70%. So it's just 1 year only. This is just talk about 1 year chart. Expect you can see leverage on that. And let's just put longer, put out 5 years. Put 5 years. S&P 500 have made 100% returns. But you do a leverage one, it managed to able to make more than 300%. Okay. But you do the short one, it lost close to 50%. But this one make more than 300%, but at this branch you see the drop here, it may get a shock. The dip is only like that, but you look at the dip of SPXI is this way. So that is what the moral of this story is. Long leverage investment is not meant for you to hold for long term because of the volatility. And number two, please don't go against US market. Please don't go and short the US market for long term, as it is a positive bias index. You go and short it for long term, you're meant to lose. A lot of people say, hey, only lost 50%. Actually, not a lot, right? Actually, it's a lot. You go and look at this chart here. You can see there is a gap up here, right? The short index. Why is it's not a gap up, no? It's a share consolidation. What do you mean share consolidation? Because it dropped too much already. It short the US market dropped too much already, and until almost the value become almost zero already. The ETF almost become zero. What they do? They do a soil consolidation. Every 10 ETF you have become one ETF. Then the price become go up. Then after it come down again. Come down again, what they need to do? They need to do a share consolidation again to make it higher again. So actually you have lose, I think 90% already on that. So do take note, inverse ETF, try not to do it for long term unless you're very, I think that the market will really drop and very accurate, then you can look at it. Leverage ETF, as long as the market go up, long term you'll make money, but the volatility is very, very high. And thus you already buy and hold, you will go for a roller coaster ride. Until here, you may say that you give up already. Now, after you give up, you go up all the way high. Okay, so that is a leverage and invest ETF. Correct. Okay, so now we talk about how to choose ETF of all these. All these are the ETF, and how are you going to choose the ETF on that? And first, before you want to do any ETF investment, you must know what is your objective. Ah, You must know what is your objective. Are you looking for what? Are you looking for growth? Are you looking for income? Or are you just purely looking for capital preservation? So what are you doing? Are you looking for passive or active? So you must understand what you want when you want. This is not only on ETF lah. Actually on all form of investment, you must know what you want. Even you need trust, even stocks. At least you must know what you want first. And example, like if you are looking for long-term growth, then of course, long-term growth is always good to buy broad market. Like for example, VOO, SPY, STI is for really for long-term buy and hold for long-term, more passive. Then you are looking for income, then of course you don't buy VOO because you don't pay dividends. For US market, you need to buy those pay dividend, for example, Charles Schwab high dividend ETF, they are mainly paying dividends, or like you may want to buy REITs, S3 ETF that pay dividend yield. Currently, STI dividend yield look also not bad, but all the while REITs ETF supposed to give you a higher dividend yield. So you need to know what you want before you buy an ETF. Are you looking for income? Are you looking for growth? So that is a key part on that. And after you look at it already, then you need to look at the sixth plan is you must understand the structure and the strategy the ETF you're buying. For example, you want to buy S&P 500, you must know what the ETF track. You must understand what's the sector weight, market cap, or geography. Like S&P 500, there's many different types. There's S&P income, high dividend income ETF, S&P equal weight ETF. There's different type by itself. SPYVO is a clear cut that follow S&P 500, but there's other type that use S&P 500, but they use it differently. So you must know what are they doing on that. Similar for Singapore, you got the STI ETF, right? You also got the MSCI Singapore Index. What is the difference between STI ETF and the MSCI Singapore Index? STI ETF only buy Singapore stocks that is listed in Singapore, which is SGX. Okay, with SGX, that will include foreign country stocks that come and list in Singapore. For example, I think a few years back, there's a Philippine company come to Singapore to be IPO. Then after they straight go into STI ETF. After one time, I think get kicked out already. It's a foreign company come and list in Singapore and got zero business in Singapore, but it's inside the STI. Okay. If I'm not mistaken, it's inside STI. Okay. So what about MSCI Singapore Index? MSCI Index is Singapore companies. They are looking at Singapore companies. So the difference is different. Singapore company, but can be listed anywhere in the world. So example, Grab. Grab is listed in the US, but it belongs to MSCI Singapore Index. But Grab will never able to come into STI Index because it's listed in US. But MSCI Index will have Grab because Grab market cap is so big. So MSCI will have Grab inside because C Limited is a Singapore company listed in US will be under the MSCI Singapore Index. So you must understand what does the index track. So both are Singapore. One is called MSCI, one is called STI. So they are talking about Singapore, but their criteria is a bit different. So this is something to note. And then you need to understand whether are they passive or active. Example, ARKK definitely is active. And VOO, all these are passive. So you need to see are they passive or active. And next is accumulating or distributing. What do you mean by accumulating or distributing? Accumulating means that no dividend will be paid out to you. The dividend will auto reinvest. You got no dividend payout. Even as dividend, they will reinvest and source. Distributing means that any dividend come out, they pay to you. They pay to you. They will not reinvest. And a lot of them, you don't even have a reinvestment option. So that's another part you need to know, accumulating or distributing. Expect. So after that, you need to understand the fee and cost. So when it comes to fee and cost, there's a few things you need to understand about fee and cost is what are the costs incurred for ETF. First, we call the total expense ratios. Total expense ratio is the total cost incurred when you buy the ETF. So VOOY is overtake S&P 500 because their total expense ratio is very, very low. I think SPY is, I think 0.07. I cannot remember the exact number. It's very, very low, right? But people say this one even lower. ARKK is on the high side because it's active. So an active managed ETF cannot be low cost. Cannot be because people need to buy and sell. The fund manager have to charge you more. So this is called the uh, lower TER is better or all else being equal. What do you mean? If both are the same thing, then let's say compare SPY and VO is exactly the same thing. Only of course VO look cheaper on that. Okay, if you put the option trading aside, let's say STI ETF and the Nikko AM STI ETF, these two they are equal, right? Then look at who is cheaper in terms of that total expense ratio. So why is that so? Is because you buy the one that have a lower total expense ratio, ultimately that one will give you a better return compared to the other one. So that is what you need to look at it. And this is publicly available information. You look at the fact sheet, they will need to tell you. It's a must to tell you. Next is this is a thing that a lot of investors are constantly are not aware is this. They only look at, oh, so cheap, so cheap. But they talk about this, they forgot about this thing called bid offer spread. Bid offer spread. Bid offer spread indirectly add into your this cost. It's not under the total expense ratio. It's an additional cost you need to bear. When you buy and you sell, there's always a spread. A lot of people are not aware, and that will mean liquidity. Let me just show you some a typical example. This is a Vietnam ETF. Vietnam ETF. XT Vietnam US dollar, HD9, listed in SGX. You can even use the SRs to buy. Okay, you want to invest in Vietnam market. This is a try. This is the option. But this is today I capture one when the market is open. So this is live market price I capture. You look at the bid and the ask. Do you see a difference? Do you see? So this is called a spread. This is called a spread. So what does a spread mean? The spread is 0.39 points. The bid ask spread is 1.17%. So what does a 1.17% mean? Means that let's say you press the buy button, you buy at this price, and you feel that you make a mistake, you want to sell, you have to sell at this price. And immediately you lost 1.17% when the market don't move at all. The market don't move at all and you lost 1.17%. And that's exclude the brokerage fee you need to pay. So this is called a spread. And ETF, selecting an ETF very important is always remember to look at the spread. Expense ratio is just one part of the equation for ETF. Spread add on to the expense ratios. Let's say the expense ratio for this ETF, let's say is 0.5%. If you add in the spread, it will become up 1.67%. That is a total cost. And plus brokerage. So does ETF cheap? Depends on what you buy. So let's look at another one. This is in SGD, this is in Sing dollar. China, XT China. I buy in the China market while in Singapore and I can buy using SI some more. I can buy in SGD some more. So a lot of people can buy. So what is the spread? 0.48%. A lot of people say quite low, quite low. Compared to this, of course, it's low lah. Then you need to plus what? Plus the expense ratio. Okay. So let's look at this one, STI ETF. STI ETF. Okay. So what is the spread? 0.12. So that is what I mean by spread. So from here you can tell that this is liquid. This is definitely not liquid. So this is something you need to take note. Don't just say that, oh, ETF is good, just buy. You need to make sure that you check the spread. The spread will means the liquidity. And what that's why I mentioned that market maker, right? What does it mean by that? For example, this one is like this means what? When you buy, nobody want to sell to you. So someone sell to you. Who sell to you? Market maker. When you want to sell, nobody want to buy from you. Who sell from you? Market maker. And thus the spread is big because there is no real buyer and seller in the market. So the market maker will need to create a unit for you or buy back the unit for you and to dissolve the unit. Definitely they cannot buy you at the tight spread. Then if not, they make what money? They need to make more money. They need to make money. So this is why the spread become big. When the spread become big, most of the time means it's illiquid. You are trading with the market maker. Okay, so this is what I mean by illiquid aspect. So that's something you need to take note. And after that, you need to look at another cost. It's called the brokerage fees you need to pay. And next is the forex you need to pay. For example, buy Singapore one in Singapore dollar, you see lower cost. But you buy US ETF, there's always a forex conversion. If you have Sing dollar, there's always you see the spread itself a bit ask spread, right? Then you Sing dollar to US dollar, there's also a bit ask spread also. And some market, you need to pay custodian fee. You need to pay custodian, for example, you buy China market, buy Indian market. No, buy not China market, buy Indian market, buy Canadian market, or even UK market, you need to pay custodian fees. Okay, so that is additional cost involved on that. Side traffic, for example, we don't talk about stock custodian fee. There's other fee like ADR fee for stock there. So these are the fee you need to take note when it comes to that. Okay, so now before I continue, let me just ask a question. VO pay dividend? Yes, VO pay dividend. What is market maker? Market maker is that's like fiduciary security is a market maker. They have to ensure liquidity in the market. Because you cannot tell completely, hey, I want to buy this ETF, how come nobody want to sell to me? So someone must sell to you. So Philip Security will tell the family, hey, there's a buyer want to buy it. So can you create something for me to sell it to him, the buyer? Then you sell to you. So that's how market work. They need to ensure that you can buy and sell, but they never say that you will buy and sell at a good spread. They just make sure that you want to buy, you want to sell, can sell, can buy and sell only. But but whether it's a good price or not, that's secondary already. So that's how it works. ETF in Germany, sorry, I didn't buy any. I didn't even look at it some more. That one first thing, why need to go to Germany to buy? That's the question. Why you need to go until Germany to buy an ETF? Okay, why you want to expose yourself to German current euro first, another currency, and that's a brokerage cheap. Usually, the cheapest brokerage will be Singapore and US, followed by Hong Kong. Okay, so why you want to pay higher brokerage fee? Unless you say that one is so unique, only Germany have. So that's another question. Why you need to go under so complex? Okay, so that is just an example of this. Okay, next we're going to talk about liquidity and trading volumes. So this come hand in hand with the bid and offer spread. So when you want to buy a ETF, it must have liquidity. So why I always look at AUM? Higher the AUM means that it is more liquid. Safer is in inverted comma. In a way, safer is inverted comma means that there's more people buy and sell. That doesn't mean you not lose money. It's just that the probability of the ETF close short is lower compared to those low AUM ETF. Okay, because ETF can come and go also. For those not aware, just like unit trusts, they can come and go. They can come. Few years later, there's one ETF specialized on what? Kings. the US dividend king. For those not aware what dividend king is, those stocks in the US market, they have been paying dividend for 50 and above consecutive years, increasing dividends. That means you buy these stocks for 50 years, every year a dividend just go up for the past 50 years, past 60 years. So there's an ETF just specialized to only buy this type of stocks. But I think this ETF only not more than 3 years, it closed out already. It closed out already. So ETF also can come and go one. Okay. Because when there is no AUM, no demand, they just close shop because they are the fund manager are there to the fund house is there to do a business. If the business is not profitable, they will just close it. So you need to check the daily volumes. Okay. So as I mentioned, teeny trade ETF are hard to sell quickly and have higher slippage, means higher bid and offer spread because nobody want to buy and sell for you. So this is something you need to take note. And this is an example. I just extract from poems platform. So I just use six ETF. This is S&P 500 SPY, this is VOO, and this is S&P 500 SPY in Singapore. Traded in Singapore is called S27. If you are not aware, you can use SIs to buy. And this, of course, STI ETF. Then you got a China and Vietnam ETF. So, and this is a screen capture today, this morning, when the Singapore market is open. When the Singapore market is open, and this is what you see. You look at the trading volumes. Of course, this is yesterday one, US market. So you look at the SPY trading volumes compared to the Singapore market volumes. Okay. So do you see a thing? And you see the Vietnam one, the bid and offer spread so high. No demand at all. Not a single person buy and sell this ETF. This one I captured about this morning about 10, 11 plus. That means from market open 9 o'clock until 11 o'clock, 2 hours, there's not even a single trade on the ETF. Okay. So there's not even a single trade. So this is what we mean by liquidity. And this explains why the bid offer spread is so high. Liquidity. And this explains why this one, the bid offer spread is low. Why? Because so much volume. So much volume. And a lot of people, not much people buy, surprisingly, not much people buy S&P 500 listed in Singapore market. Not much people know. Because first thing, a lot of people not even aware that it's such thing. Number two is, it looks funny for me to buy a S&P 500 ETF while the US market is closed. I buy in Singapore market. Who am I buying, trading with? Okay, where the big boys are all sleeping already. So this may be why the volume is also very, very low, and a lot of people are not even aware that is such thing. But one consideration that you can use your SIs to buy. Okay, it's not asking you to go and buy, but just to share with you on that. Of course, there's other alternative also. And next, of course, you need to look at the geography. Where are the ETF located? And after that, the currency. Currency. So as I mentioned, like, let's say you buy the China S&P 500, that's not the China ETF, right? It's China. So even the ETF is in USD, right? In SGD, right? Yeah, exposing your currency risk to renminbi. It's just that it translates to Sing dollar for you. You never see, and you see for ETF, it's not hedged. They don't hedge currency. For unit trust, they will hedge. You can choose the hedge class, hedge to Sing dollars, share class. But for ETF, it's all unhedged. It's all unhedged one. So actually, you are exposed to forex risk. Because what you see is in Sing dollar, but underlying, actually, they are buying foreign currency stocks. So you're exposed to the currency movement. So this is example, the China ETF, as I mentioned, you're exposed to that by not knowing, not aware of that. So this is something you need to take note on all this. Okay, so this is the list of ETF, okay, that is listed in SGX. I extract it out from SGX one. You want to know how to extract later? I show you. On this one, I extract of these 50 ETF that's listed and SGX. These are all in Sing dollars.